Recipes for technical trading success in Cook's Kitchen.
Why do so many investors waste so much time trying to call the top in this bull market? I'm going to give you two reasons today. One, they don't understand classic bull market behavior. And two, they're probably scarred from the last bubbles in 2000 and 2007. Let me back up here a second and just show you how I can sometimes be wrong trying to call a correction. Remember in January I was looking for the perfect storm, what we'll now call polar vortex number 2. And that's because I saw a deep freeze of earnings estimates getting reeled back over 10%, representing no growth for 2015, which raised the PE multiple, obviously. Then the heavy winds of the surging U.S. dollar, with the euro plummeting on ECB QE, a headwind to U.S. multinationals and earnings. And then finally, the FOMC, highly motivated to get off zero. Remember, on January 30th, Bullard from the St. Louis Fed said, hey, zero rates are not right for this economy. So all these things made me think we were at least due for a correction, and we were going to go down and check out S&P 1900. But the market held up well. Let's see what's going on here. Here's my S&P chart taken this morning on Monday, March 16th. You can see we're pushing above 2070. Let me dial in my pointer here. So here we are in the upper right with the yellow. 2074 was pushing new highs, back into the territory we want to see the market. This green arrow I circled here, or this green circle, ellipse, is important because this is the bullish structure that I'm focused on that, really the market would have to take out for you to have any kind of serious correction. I was faked out here in early February. I thought once we broke 1990, it was going to be lights out for a while based on my perfect storm polar vortex thesis. Didn't happen. February was terrifically strong. And then we took some profits here. Now we pulled back, and this market continues to exhibit strength. We're not even filling this gap. Feb 3 right here, you can see it on the spider chart bigger. That's actually a pretty big gap, and I thought it would be a magnet attractor. We haven't been there yet. We filled the gap from Feb 12. But the market holding up well, bouncing off the 100-day moving average here. I'm not showing the 100-day moving average. But this is really the key, what's in this ellipse. This is bullish structure in December and January, and my money's on the market holding above there. We're entering a 2-day Fed meeting tomorrow on Tuesday, and this is a big quarterly quant fest where we're going to get their fresh economic projections and a press conference from Chair Yellen. Now, will they or won't they remove the word patient? Who cares? They're either going to start liftoff in June, or they'll probably hold off till September. Either way, any knee jerks, reactions lower in stocks, I think you want to buy. All right, now let's go big picture again. Let's talk about why people want to call the top in the bull market. Here's one good reason. This is here's your average bull market graphs going back to the 30s, I believe. Yeah, I think this is, yeah. And it just goes up from oldest to youngest. So this chart is actually from the middle of 2013. So in September of 2013, this bull market was only 4.5 years old. You can see it, the most recent at the top. We just hit 6 years last week. March 9th or 10th, hit 6 years. So how old did that make it? Well, all of a sudden we jumped up to number 4 on the all-time oldest bull markets when the average is 3.8 years. So people make a big deal about this. If you want to look at this graph more closely, just hit pause on the video and you can stare at it for a while and get the comparison down. So this worries people. I don't think this is the valid comparison to make. So I'm going to go back to the one I showed you last fall and forget the length of the bull market itself. Let's talk about the length of the economic expansions. So here we are. This is going back to 1854, 34 some economic expansions. The average is 39 months, the median 30 months. And where are we now? Well, so we're all the way here on the right. Started in June 2009. We've crossed 60 months, and because that would be 5 years, and we are headed, to take out this bull market or this expansion, and this one here. We're gonna in June of 2015 here, we'll finally hit 6 years and 72 months on an economic expansion and become move from being the 6th longest, which we are currently, to the 5th longest. Then I think this thing can keep going. I think we can hit the 4th longest at 80 months. So that would be this guy all the way back here is currently number 4 in the longest economic expansions, and that was off of the Great Depression. Finally, in June of 1938, the economy got liftoff, and this lasted, what would 7 years would be 84 months. So this almost made it into early October, or I'm sorry, early 1945. Say late winter, early spring 1945. This one ended at 80 months, and I think that the current expansion will move on, not only become number 5 this June, obviously, but it'll become the 4th longest and take out 80 months by the first quarter of 2016. Now, why do I think that? Because all the conditions are there. We're not looking at anything recessionary on the horizon, and monetary policy is still a huge headwind. So that's why I think this expansion keeps going. It's very unique in that sense. And one last point here. So I got this from Forbes a couple of years ago, and they asked, was this a golden age? And so they've got this dotted line around the expansion since 1980 during this bull market. So, the bull market that went from 82 to 2000 had 3 distinct economic expansions, obviously recessions in between. Was that a golden age there? And I think it was. I mean, when you look at what computers and technology did to create productivity and to create new wealth, that's still going on. And I'm not just talking about wealth for stock market investors. We're talking about innovations in other sectors, in the medical field, in building materials, what have you. So that kind of innovation and productivity is what can make this current economic expansion number 4 and part of that golden age of just tremendous growth. All right, my next topic. This is from LPL Financial. Let me just back up here a second. I just wrote a paper a few months ago on what to look for in the bear market, or when a bear market's coming. How will we know? And I'm glad I did that, because now I find this list from LPL, and they're looking at the same things. So I'll just run through the list, but you can obviously stop this video. What's the first thing they're looking at? What's the yield curve doing? Obviously, an inverted yield curve kills the bull market. Do we have one now? No, we don't. Check mark positive there. Leading economic indicators. When those take a turn, that could be a sign. And you can look at your own indicators. I look at retail sales and the PMI and ISM numbers. Market breadth. Obviously, market breadth was a big topic last year when we had the NYSE composite falling down, the Russell 2000 falling down, and giving us signs definitely of a correction, but would it be the top of the bull market? Well, the Russell is breaking out to new highs, and the only reason that the NYSE composite is still down in the dumps, hanging out below its 200-day moving average, is because of energy. Energy is still the dead weight there in the NYSE. All right, so they mentioned Purchasing Managers Index here, so you can think of that as linked in with the ISM data. And again, all these things are saying no, there's no late cycle warning. We do not have a recession warning yet, even though the bull seems like he's getting old. Now, the one they're concerned about is PEs. So they say, for valuations, PE of the S&P 500 above 17. However, it can stay elevated for a long period of time. Well, that's where we are. when we had the earnings evaporation, where earnings rolled over and we lost, over 10%, on the headline number for the S&P 500 from, above 130 to below 120, that brought us down. That brought earnings down so much that the PE did move up to 17. So if you look at, just use a round number of S&P 2000, if we're only looking at $117 of earnings in 2015, that is a PE of 17. So we want to see these earnings estimates turn back up after they've been sort of wrung out on the energy trade and pessimism. All right, bulls do not die of old age. This is I think Leon Cooperman, one of my favorite fund managers. He's guy's been around forever. He loves to say this: bulls do not die of old age. What do they die of? They die of excess. PE multiple pushing into 18 to 20 times. That's why my forecast in August of 2014, my forecast was for S&P 2250 by this April, because I thought I'd have this math. I thought I'd be able to say the market's going to pay 18 times for $125 of S&P earnings. Well, now that $125 is in question, and probably the 18 times is too. So my 2250 forecast by April is looking, it's in jeopardy, let's put it that way. But the bull market is not. It's just going to take us longer to get there. All right, what else do bull markets die of? Well, they die of euphoria, when everybody loves stocks. Obviously, that happened in 2000. It's connected to the PE idea, and everybody's, the cab driver's buying. Here's one reason I think the bull market. Another reason I think the bull market has longer is the great rotation can still happen. And if you think about where Fed funds could be a year from now, what if the Fed starts liftoff in, let's say they don't start till September, and they do 25, 50 basis points, and then they do it again in early 2016. So a year from now, we could be looking at Fed funds of 1%. Is that an economy killer? No way. It's not an economy killer. It's not a bull market killer. It's still extremely accommodative. And that's probably the worst case, that a year from now we're at 1% Fed funds. So, what's going to put the top in the bull market? I don't see anything happening yet to do that. All right, finally, let's talk about classic bull market behavior. Now, so I wrote this short piece for my market timers over the weekend, and I'm trying to string it all together here, as I like to do, put lots of pieces of the puzzle together to come up with one theme. And my theme is, what is classic bull market behavior that's telling you, hey, this is not over, aside from the economy. And that is watching institutional investors. What have they been doing? Have they been net sellers or net buyers of stocks? Of course they've been net buyers. And that's why, the market is doing what it's doing. But the place to really look for it is in individual stocks. Because if you look at an individual stock and you see different funds accumulated in over time, and then ask yourself, why are they buying this stock? What do they see? They're not doing it for a 3-month trade. They're probably doing it on a 2 or 3 year thesis. So here are some names I just threw together of stocks that we picked for FTM back in 2012 and 2013. Medivation, Pharmacyclics, Valiant. Valiant just took off, is blasted up to $200. Harman finally broke out. What investors had in 2014 had to watch this stock just go sideways, between 100 and 110, and then finally, the earnings story pays off, and everybody who was short it had to cover them, and now people recognize Harman. These are the infotainment guys in your car infotainment. Skyworks, great chip maker that we've loved. We've caught 50% in this. High content in Apple phones and RF chips for the Internet of Things. Avago, similar type player. Visa, no need to explain there. So I've got basically my top line here is, my top row is healthcare, then this is more technology, Harman, Skyworks, Avago, and then, technology with a consumer face, Visa, Apple, and Ulta. Ulta Salons, blowout earnings last week. That stock's finally above 150. So these are just 9 stocks, and maybe they have reached some sort of peak where institutions are going to begin taking their profits. The guys who were long you know, they've got 100 or 200% profits in the name, they're going to start trimming back. But for every 9 of these stocks, there's, you know, dozens more, and you want to look at them and you want to look at who's buying them and try and figure out what's their thesis and how far are they looking out. Because when the big guys buy these stocks, you know, they have to put their money down and they can't trade in and out all the time. So they're prepared to take the 20 to 30% drawdown if there's a bad quarter or a correction. But knowing that that's an opportunity to add to the position and see their thesis fully realized during an economic cycle. And since this cycle has more to go, I think you're going to be seeing a lot more stocks make new highs in 2015. All right, that's my thesis of classic bull market behavior. Use it to your own wealth. I'm Kevin. Thanks for joining me in the kitchen.